Okay, good afternoon. Thank you so much for joining us. For those of you who don't know me, my name is Jillian Carter. I'm the Associate Director of Heritage Christian Services, and I have the privilege of serving as the President of the Genesee Valley Chapter of the Association of Fundraising Professionals. I have a few brief chapter updates that I wanted to share before I introduce one of our newest chapter members to you. The first update, we do have the Karen M. Gaffney Scholarship for AFP membership that is now accepting applications. The purpose of the Karen Gaffney Scholarship is to promote and enhance the professional development of fundraising professionals and to encourage involvement and membership in the AFP Genesee Valley chapter. To learn more about how you can apply, please visit AFPGV.org and you can click under professional development, and there is a link there that you can click on for scholarships. Additionally, you can learn more on our website at AFPGV.org on the AFP's, our chapter's mentorship program. And the purpose of that mentorship program is to help members, particularly those who are new to the fundraising field, transition into their role by meeting regularly with seasoned AFPGV members, other fundraising professionals who will serve as their mentor. We recognize how hard it can be to find opportunities for one-on-one social connections, especially during this pandemic that we are in. So this is a great opportunity. We have a bunch of eager mentors ready to be paired. So if you are a mentee who are interested, please again visit afpgv.org, again under professional development. You can learn more and apply. And if there are any seasoned professionals out there, feel free to go to that same link and you can note your interest there as well. I am grateful that you are all engaged with AFP. I know it's, again, hard to network these days, but we are definitely taking advantage of these Zoom opportunities. I'd love to take just a few moments to spotlight one of our newest AFP members, Andrea Carvalho. Is that correct, Andrea?
Carvalho, that was close.
Andrea serves as the Program and Events Coordinator at Causewave Community Partners. Andrea, welcome to AFPGV. Would you please share a little bit about yourself with us?
Thank you. Yeah, it's nice to meet everyone. So like was previously said, I'm the Program and Events Coordinator for Causewave Community Partners, and I've been working with them for almost 3 years now. And if you're not familiar, we're a small nonprofit that works on nonprofit capacity building. And I, right now, a lot of my role is revolves around event planning and some other fundraising efforts for Causewave. And I'm super excited to learn more about individual donor engagement in the future. When I first started working in the nonprofit field, I thought a fundraiser was someone who knew the ins and outs of a budget. And I quickly learned that a good fundraiser is a good storyteller, and that's really where my background is from. I have a creative background, so that was really important to me, and I'm very passionate about storytelling. And I'm really eager to expand my knowledge of fundraising and meet other young professionals as well. So thank you so much for being so welcoming so far, and I'm really grateful to have this chance to introduce myself.
Thank you so much, Andrea. Welcome again. We are extremely grateful to have our great friend of the chapter joining us for today's presentation. Michael Cooney is a partner at the international law firm of Nixon Peabody. He heads their higher education and exempt organization groups. With over 3 decades of experience, Mike is a great, valuable member of our community. He's here today to talk about how decisions are made in DC, and how they are impacting and influencing our work in philanthropy. A member of our education committee, Emily Marullo, will be helping facilitate questions to Mike. If you have questions throughout the program, please feel free to add them in the Q&A box at the bottom, and Emily will address those. Without further ado, please join me in welcoming Mike.
Terrific. Thank you so much, Dylan. Let me see if it's possible for me to advance. I seem to have lost my buttons down here in the lower left-hand corner. Yeah, this isn't it. Oh, there we go. There with, well, look at that young guy. That's what I looked like 20 years ago. So I wanted to go through today. It's great to be here with all of you. I'm especially excited to hear about meeting young professionals, considering that my recollection of doing this stretches back a couple of decades. And it's great to be able to share all of this with you. I want to emphasize this is really my perspective as to what we're looking at today. There are literally daily developments here in DC when they're not stacking the Capitol in terms of legislation being discussed, being introduced, and a number of those things are going to impact charitable giving. Some of them directly and some less intentionally. To put a context on this, we're moving from one regime into another one, and the two of them, from a tax policy perspective, from a governance perspective, couldn't be more disparate. And that's somewhat problematic for us, particularly as fundraisers. Earlier, there were the statements about being storytellers as fundraisers. That's absolutely the case. And you want to get people to become and buy into your narrative, your story, to bring the humanity to what is there. And I must say that at this time, more so perhaps than any in my career, we have a challenge because so many of the basic rules and the tools that we have for charitable giving have either been changed by the Trump administration or are in the process of being changed by the Biden administration, with some of those concepts reaching back as far as the Obama administration. So it's a challenge for us, I think, to have, when it comes to charitable giving, to have a consistent story. So much of that story is yet to be written, but even so, the changes are pretty dramatic. So, you know, where do Quo Vadis? Whither do we go? Charitable giving. We've got the CARES Act from earlier last year, the Coronavirus Response and Relief Supplemental Appropriations Act at the end of last year. We're going to talk a bit about some likely Biden proposals, and a lot of this is really crystal balling by me. I've got a list of things here that I'll just raise for you as things you might want to think about. And we've got as well the Tax Cuts and Jobs Act, which oddly enough, that's not really the name of the act. They sort of messed it up in Congress in terms of the way that it was transmitted between the Senate and the House. And so whenever you see this long title for a tax act, you know it's the Tax Cut and Jobs Act. So let's take a step back. Very important whenever we're talking about charitable giving and particularly legislation, what's coming out of DC. The current environment really is a fascinating one, and in so many ways, again, that narrative, it's a story of charitable institutions doing right by the public, of a need being perceived and addressed. I have the good fortune to be a member of the Mother Cabrini Health Foundation board. We had our board meeting yesterday, and the sheer amount of money that that organization has put into healthcare and health-related services throughout New York State is really incredibly impressive. But you know, there are others here too that when you look at the current environment, the things that are being done, you can't help but be incredibly proud of what folks in our sector, the nonprofit sector, have done in relation to the pandemic, the racial unrest, and the economic situation for so many Americans. I point out here 5 major foundations: Doris Duke, Ford, Kellogg, MacArthur Mellon, committed over $1.7 billion in the next 3 years to nonprofit organizations in the wake of the pandemic. I was involved with a couple of these because our firm did work in terms of issuing tax-exempt bonds, the purpose of which was to take the proceeds and inject it as quickly as possible into the community. And while generally speaking, these sorts of foundations don't go out borrowing money, it was seen as the quickest way using their balance sheet to be able to attract funding in the bond market and then put it out incredibly quickly. I mean, that is much as with Mother Cabrini Health Foundation, that's a lot of money to intelligently move out to meeting the need. But who's better situated to be able to do that than our nonprofit organizations, right? I mean, part of the concept here, a major part of the concept, I would say in many ways, it really distinguishes the American charitable and charitable giving world from anywhere else in the US, is that instead of paying $1 to the government by way of taxes and having them figure out how to allocate it after taking 20 cents, 30 cents, who knows how much off the dollar, in terms of charitable giving, donors looking within their communities can decide what best to fund and make that gift directly, avoid tax on the income as earned, and perhaps even getting a bump from contributions of appreciated property like stock. But importantly, having direct access to the organizations that help the beneficiaries. All too often, I think folks take our network of organizations for granted. I, in recent years, have spent quite a bit of time dealing with international grant making. And I mean, even as compared to very well-developed places like the UK, Canada, Australia, we have got an infrastructure that our roads may be crumbling, but I certainly hope that as a result of this pandemic, our charitable provision infrastructure holds up. In July of this year, Charity Navigator, and full confession, I'm on the Charity Navigator board as well, but it's the world's largest, most relied upon independent charity evaluator. We like to say that we're democratizing charitable giving by putting information out there, analysis out there based upon organizational 990s and other information. Well, this year, Charity Navigator announced a new nonprofit rating system called Encompass, based on 4 key indicators. So the organization is sort of stretching out the information that's available to donors to be able to use to make gifts. McKinsey & Company, back in May of last year, seems like a million years ago, observed that the philanthropic response to the COVID-19 pandemic has shown the sector at its best, which is all to say that thank you to all of you who are listening and your compatriots, your colleagues in the work that you are doing. I wanted to include here some of the observations from Fidelity Charitable, which, as we know, has access to an incredible amount of capital. The points that they came to, most donors plan to maintain or even increase the amount they donate to charity this year. The charitable giving market has remained remarkably resilient. Volunteer activity likely to decrease because of the pandemic. Donors concerned about the way that COVID-19 could impact health and human services, a great amount of concentration in that area. And a statement that most donors don't plan to shift their giving to different organizations in light of the pandemic. Charitable giving in many, many ways is not a matter of picking one from column A, one from column B. People give to organizations they know, love, and perhaps most importantly, trust. So again, going back to that narrative, hugely important. But at the same time, a lot of donors don't feel they have the information they need to effectively support efforts to combat COVID-19. I think that since these statements were made by Fidelity, and you've got the website just below, that more and more organizations have been responsive on this side. So, but what's the reality that we see out there as providers of charitable services? Those 5 private foundations that really are remarkable in terms of what they bring, not only economically, but in terms of the conversations they ignite and support, live admittedly in a rather rarefied air. Here's a picture from the 1930s, and I think what it does, at least for me, is it represents sort of the feeling of so many people who are out of work, who are underemployed, who are really concerned about what things are going to look like when we all get vaccinated. Most of us get vaccinated, and we get out past this thing. There are absolutely going to be changes in the economy, right? I mean, I have a number of folks saying, why do I ever need to go into the office again? We've all proven that we can work remotely. So maybe it's not a great time to be in the commercial real estate business. Maybe it is. But there's going to be quite a few changes. And I think there are going to be quite a few changes in our charitable infrastructure as well, despite the fact that we've got forgivable PPP loans and other benefits that came to us through the legislation that was passed. Not all organizations are going to make it, unfortunately. And so there's going to be quite a bit of adjustment that needs to be done in light of those changes. So here are some trends in charitable giving. I had the honor of speaking with you, I guess it was 2 years ago now, and wanted to bring up these trends again. At that point in time, we were in the middle of the Trump administration. It was the 100th anniversary of charitable giving in the United States, starting with the changes to the tax law in 1917 and going through 2017, and an incredible accomplishment. Speaks so well on behalf of the giving community, but also the charitable sector. So the trends then were, concentration of giving. We were seeing more giving being done by fewer folks, really trending toward the higher economic end of the spectrum. We saw then, and I think we're seeing now, greater donor involvement and control in terms of our charitable gifts. And that despite the fact that there are a number of situations where organizations, in light of the pandemic, made gifts or grants, and then situations changed. And so the funders were willing to change as well, which was very heartening. What that means is that they trust your organizations to make sure you're doing the right things. We are still seeing more complex asset gifts as value is found in different types of different asset classes. More and more organizations willing to entertain gifts that go beyond cash and appreciated publicly traded securities. A heightened reliance on charitable intermediaries such as community foundations or the charity navigators of the world, the guide stars. But the real point of emphasis here, I think, is this increased uncertainty. During my 3 decades plus, markets have gone up, markets have gone down. Thankfully, the markets seem to be rather strong still at this point in time. But there is absolutely increased uncertainty as to what the nature of charitable providers is going to be, what institutions will survive, thrive, adapt, find other ways to remain relevant, and how will the giving community adjust to all of that? These are questions that all of us face, and it doesn't fall equally to all of us. I think they're going to be very different situations and outcomes. So what does that mean? Well, I was just on the phone this morning speaking with some of my accounting friends from BDO about a presentation that we're going to do to governing boards, and about how they need to be thinking differently. Even now we can see this in light of so many of the changes that have come with the pandemic, the economic response, and as I said, the drive towards greater diversity and inclusion. So, Tax Cut and Jobs Act, you'll recall as you dial back that the Trump administration had lessened somewhat the applicable rates at various tax brackets. I was reminded recently, my wife and I keep in our tax folder, and we always get our taxes done early, but she has a pamphlet in there that was written for the executive leadership at Republic Steel, where her grandfather was the head. And the rates for ordinary income back in 1944 were close to 90%. So it really wasn't until IRTA in 1981, Reagan administration, that rates dropped below 70% ordinary income. So the bottom line is, historically, these rates are rather low, but what we're going to see now, this was Trump, what we're going to see under Biden is they need to pay for all of the relief that's going on, including the relief to local governments and whatnot. And so that absolutely is going to result in an increase in these tax rates. In 2018, the standard deduction amounts as set forth here, they increased so that for us, a number of folks who were making charitable gifts and itemizing them on the returns no longer had the need to do so. You got the standard deduction whether you made a gift or not. And so that resulted, and I'll show you a chart in a second, but resulted in an incredible drop in the number of itemizers from 30% to 5%. Does the ability to take a tax deduction make people engage or employ charitable gifts? No, we all know if they don't buy your story, if they're not, they don't feel that they're part of the narrative, no amount of tax deductions or tax maneuvering is going to make a difference. However, that being said, it is hugely important that we have laws that promote charitable giving. Again, it's a very effective and efficient system economically, and that those be consistent, because in terms of tax policy, if you're changing from year to year to year, as all of you I'm sure know, it's really hard to catch up. It's really hard to stay abreast of what the distinctions are and what the rules are going to be. So again, just 3 years ago, we had this increase for cash gifts on the adjusted gross income ceiling for gifts to public charities, and that doesn't include private foundations, didn't include, gifts to public charities, moved from 50% to 60%. Now, again, it is the rarer donor who is affected by an adjusted gross income ceiling, who's giving away 50% of their income in any year. But the trend here was to emphasize cash gifts to public charities and not, for example, to donor advised funds. You're going to see this as a theme playing out, that the reaction to the pandemic from a congressional legislative perspective was to sort of remove the ceilings upward so that more people who had the ability to give could give. However, with the Tax Cut and Jobs Act, you'll recall just again a few years ago, for those of us in high tax states like New York, we're considering whether or not it was possible to pay our state taxes a year early before the cap came along. These issues remain we still have not resolved so many of these issues about deductibility and state and local taxes. Here is a chart comes from Brookings that shows the drop in the number of itemizers as a result of the 2017 tax changes. Pretty dramatic and incredibly quick. The taxpayer market was very quick to change on this course. So what about the CARES Act, right, in spring of last year? Well, it put about $2 million in financial aid out there in the community. It instituted an interesting concept. It's not one that's unique. We've toyed with it before, but an above the line deduction for cash contributions of up to $300, even if you use the standard deduction. So while the Tax Cut and Jobs Act moved so many people to the standard deduction and didn't have them itemized, when it comes to the CARES Act, we even supplemented that so that somebody could make even if they itemize, they could make a deductible payment of $300, and as you'll see, which was then increased to $600. So a number of other changes here with the CARES Act, all of which were really driven to try to get as much cash and capital into the charitable services system as possible. And you see the point here that so many of these different aspects were not available for non-cash gifts. So appreciated securities, real estate, whatever the case may be, or gifts to private foundations, supporting organizations, donor-advised funds. I think there has been, from both sides of the aisle, a pretty consistent drumbeat about charitable gifts getting into public charities and then getting out or being spent even, right, in order to provide services to the public. Donor advised funds are a great example in that there remain these lingering concerns about whether or not contributions made to DAFs are simply substitutes for private foundations and will adhere strictly to a 5% payout requirement, even though they're not legally required to, or should something differently be done. All of the studies that I've seen with respect to distributions out of DAFs have demonstrated that the distribution rate is above the 5% private foundation rate. So that DAFs may be getting a bad rap in that case. But again, there is a segment of the population, and some of that population is in Congress, who simply don't like this giving vehicle because they feel that it is a delay mechanism. It's something that doesn't enhance charitable services as much as it could or should. One would hope to have an open and complete discussion on the subject, but unfortunately, the way that tax legislation gets done, a lot of this gets done behind closed doors and in the hallways of Congress and now over the internet. And so it's a bit of a challenge in terms of trying to get good information out there. So as you look at the CARES Act from last spring, a number of steps being taken in order to try to infuse the charitable network, charitable service network with cash gifts. The whole subject of charitable giving and not itemizers, I think, is an important one for you and your organizations to think about. And as you'll see toward the end, I'm going to emphasize the importance for all of you, and I know that many of you do this, of knowing what your donor community looks like. You know, religious organizations, by way of example, are remarkably steady in their level of charitable giving year after year after year, both as a percentage and from whom the giving comes, because whatever might be in the latest tax act, people are giving to their beloved religious organization for benefits that go far beyond a tax deduction. At the other end of the spectrum, in some sense, are perhaps arts and cultural organizations that certainly are supported in many ways by, for example, folks who itemize their deduction, fall in those categories. But for major gifts to arts and cultural, to universities, and even in healthcare, those folks are the 5% who do indeed itemize. So they're going to be treated very differently. So what's the point here? Your organization needs to look at its charitable giving, who comes to you, and segment it out, figure out where those donors are, and where there might be giving incentives that would be particularly helpful to them. So the very discussion here about itemizing, I mean, why do we itemize charitable giving along with interest on principal mortgages, right? Or state and local tax, SALT. There's not necessarily a reason why those need to be tied together, and arguments could be made, as is done by the National Council of Nonprofits, that they shouldn't be tied together. But this really speaks to understanding what the tax benefits are for your particular audience. This act was at the end of last year, extended a number of the provisions in the CARES Act, kept them in for 2021, although, as I'll point out with respect to the sort of the new regime and the Biden tax proposals, a little unclear as to how much of what was left over from the Trump years will still pertain. And as I said, generally speaking, having some level of consistency in charitable giving and not having to go out and have people rethink or redo their giving every year because the tax law has changed. I mean, I think that makes it more difficult. Yes, it's a touch point. It's an opportunity for us to reach out to our donors and have conversations. But especially in this environment where we're all on lockdown, those conversations can be done much more easily and quickly than they did in the past, when it was a matter of getting on a plane and heading out somewhere. At least that's my experience. So let me speak a bit about the Biden proposals. This is all, in some sense, crystal ball kind of stuff. We do expect there to be tax legislation in the fall. It won't be immediate, but it's something that Congress absolutely needs to concentrate on, because they need to figure out how the bills are getting paid. It's an interesting environment, as all of you know. The Democrats have a de facto 50-51 Senate majority. And so if you're Joe Biden, now is the time to move. Who knows where things are going to end up in the midterm elections. The blue wave wasn't as wavy as folks had expected. And even this Senate majority, right? Tax bills start in the House, come over to the Senate, is very vulnerable. I mean, down here in DC, it sometimes feels like, Joe Manchin from West Virginia, a Democrat, but a moderate Democrat, is kind of running policy, because the president needs him to be on board in order to get the votes that he needs. I could give you a whole explanation about filibusters, ending filibusters, cloture, so on and so forth. But, that's a lot of, frankly, parliamentary maneuvering. The bottom line for you to take away is we absolutely will have tax legislation this fall, and that in some way, shape, or form is going to affect charitable giving, whether directly or not. I've had folks ask me, in light of the fact that we had sort of the Trump administration moving in one direction, and especially very recently trying to get cash into the charitable provider world, what happens when the Biden administration comes in and changes things up? Can there be retroactive application of tax laws going back and you weren't even aware that this was going to be the case when you made your gifts to your children and expected to have a higher unified credit? Well, in point of fact, constitutionally, it's permissible to have a retroactive tax, and we've had some occasions where that's been the case. The question here is, I guess, how far back will Congress go? Certainly, they can't go back to a tax year that's closed, but I've had a number of people come say to me, what should I be doing today in order to protect myself? And the answer is far less than clear. At the very upper end of the spectrum, and this is sort of testimony as to how the politics are playing out, we've got Senator Elizabeth Warren and the ultra millionaire tax. It would bring about $3 trillion in revenue over 10 years without raising taxes on the 99.95% of American households. It's a 2% annual tax on the net worth of households and trusts between $50 million and $1 billion. That is certainly rarefied air, and not many of us on this call have a Rolodex of donors in that category. But it does give you some sense as to where Elizabeth Warren and other supporters are concentrated in terms of who should be paying the bills that arise out of this pandemic. What are the rates going to be going forward? Well, we think that we're probably going to see the rates go back to the pre-Tax Cut and Job Act days. And in particular, there's a lot of discussion about taxpayers making more than $400,000 per year, right? It becomes the question of, well, who are the quote unquote rich who can afford the application of these taxes while the poor and the working class, quote, the working class, are going to be protected. Right now, that number appears to be around $400,000 per year. It's unclear whether that's going to be single filers, joint filers, or both. Is that threshold going to survive the legislative process? But it certainly has gotten a lot of people's attention. The other thing that's got a lot of people's attention is not only an increase on the ordinary income rates, but capital gains rates. And politically, this has always been an issue. The Republicans, of course, like low capital gains, the Democrats higher. And I would be remiss not to admit that from the perspective of a charity, we seem to do better when there is a higher capital gains rate, because what that means is we can afford a donor an opportunity to avoid that tax on gain of contributed property. So if you've got appreciated publicly traded securities, the fact that there is a higher capital gains rate, generally speaking, tends to make donors more willing to make charitable gifts of those amounts. So that is something that we'll need to watch closely. Obviously, politically, it's not a situation where charities are going to stand up and demand higher capital gains rates, but it is something that we expect to see. What that means is if those rates increase, and the number here is $1 million, that for those with income of more than $1 million annually, the capital gain and dividend tax rate would move from the current maximum of 20% to 39.6%, which when you add another 3.8% of the net investment income surtax, you've got a top federal rate on that income that would almost double to 43.4%. So this could be a major hit for taxpayers, and one which we need to keep a close eye on, because in the regular consideration, of the almost annual consideration, right, when you're doing your tax returns, well, would you rather pay $1 to the government, or would you rather pay it to a charity that you know and love, whether Democrat or Republican? The answer to that is almost uniformly, in my experience, to have it paid out to charity. All of that being said, on capital gains, I mean, it remains an important thing for us to pay attention to. But one of the things that's fascinating to me, and again, especially at the higher end of the giving spectrum, I'm seeing pledges being done and multi-million-dollar gifts being made, not with appreciated property, but with cash. And why is that? Well, the world is awash in cash. It was before the pandemic hit. And the fact of the matter is that for many of the high-end donors, if you will, they have been very generous in the past and already have pretty large carry forwards that are there. So it's not as much about the deduction, and they're able to make cash gifts. So that's something that sometimes we presume that all of our fancy tax planning is going to make the difference. Again, this goes back to the point of your ability to portray the narrative is hugely important. We expect there's going to be some tinkering with respect to AGI limitations. And what are these? Well, how much of your annual income can you give away to charity and not have it be subject to taxation, right? Are we going to allow people to give all of their earnings away and not pay any taxes? Again, the lifting of the AGI ceiling on cash gifts to 100% from the CARES Act again, only applies to cash gifts and cash gifts to public charities. This is a much broader issue. So in terms of AGI limitations, there's some discussion about that being at 28% for itemized deductions. So taking some of the benefit away of our ability to, in essence, help people shelter amounts received by them from taxation. So a taxpayer subject to a 39.6% rate, for example, who makes a charitable cash donation would pay tax on income used to fund it at a rate of 39.6%, but receive a deduction at a rate of only 28%. That's a major change from the direction we have been going in prior. Estate taxes are always something that we need to pay attention to. I still think that income taxes and income tax deduction for most of our donors are the huge drivers, with the increase in the unified gift, estate, and generation skipping tax exemptions up to the current level of $11.7 million. That allows quite a few of our donors not to have to worry so much about estate tax and instead concentrate on income tax. But again, there are expected to be some changes here that might deviate from the current landscape. For example, these current rates are only in place to the end of 2025. They might be changed earlier. So what happens if you drop the level of the exemption for estates from 11.7 down to 5 million, or some discussion from previous proposals during the Obama-Biden administration, taking that down to $3.5 million. What that means is that there are a lot more donors who are going to be concerned about dealing with their estates rather than current gifts and income taxation. One of the big issues here, and I say this is very, very unclear, highly speculative at this point in time, but there are some benefits in the estate tax context that, I mean, they enact a very high price, but they're very valuable. What do I mean by that? Well, for example, when someone dies, they can transfer property and get a step up in basis upon death. And so that step up sort of bringing from the amount of your original basis, what you had paid for a piece of property, and then taking all the appreciation into account. That step up is hugely beneficial in tax planning going forward. The cost, of course, is that someone's got to die in order to get the benefit of that. But it's something to keep in mind. What happens if the administration takes away that step up in basis and instead requires you to have carryover basis, thereby making those assets less beneficial in the hands of the decedent's family and others to which gifts are made? That sort of change would be very, very dramatic. I think it's more likely we'll see a change, an increase in the current rate from 40 to perhaps 45% with respect to the estate tax. But as you think about it, if they were to take away that step up in basis, what it would mean is that there would be a stronger incentive for people to give appreciated property to charity during their lives, which generally people would rather give during their lives so that they could see what benefits are accruing to their giving. But again, as I say, these elements in estate tax are something that we need to keep our collective eye on because it does make a difference for our charitable giving. In years past, I've used the giving triangle, right, where at the top is the donor, the next segment down is the donor's family and other loved ones, and then charity. It's sort of we are third. Well, it's very important for the tax law to be supportive of those first two tiers, so that we can provide an opportunity for generosity that goes outside of the family, if you will. Again, I think we're going to see more concentration on relief for non-itemizers. I mentioned donor-advised funds. I think we're going to see a proposal for a mandatory payout, probably linked to the 5% that's used for private foundations. There was a notice that the IRS published in 2017 that spoke about some aspects of donor-advised funds, and from the IRS's perspective, their perceived misuse, not only in supposedly not getting enough money out, but in allowing folks to make payments that supported the public charity status of their donee organizations, where, if it had been done directly instead of through a DAF, it would have been treated differently. IRS is very, very busy. And in fact, I know personally one of the people who's writing the regulations in this arena. And I think that they may well be eclipsed by congressional activity. I'd be remiss if I didn't mention something about corporate giving. The Tax Cut and Jobs Act reduced the corporate tax rate from 35% to 21%. President Biden proposes to raise the corporate tax rate to 28%, or possibly even back to 35%, and bring back the corporate alternative minimum tax. Corporate giving, again, important, not as large as individual giving in the grand scheme, but it is going to be affected, doubtless be affected by increases in tax rates for other taxpayers. I made mention of the alternative minimum tax. You'll recall that this is sort of the phantom tax system that lines up with our normal tax system. And if the response in the normal tax system is that someone's not paying enough tax under they're subject to the AMT, and so that will come into place. The Tax Cut and Jobs Act kept the AMT in place, but raised the exemption so that it affected fewer donors. The expectation now is that that might slip back. The AMT produces about $600 billion a year in federal taxes from the top 1% of taxpayers. And that last point is really important. Again, so much of what goes on in the Biden administration is going to be premised on tax equality, if you will, and making sure that the upper portions of the donor community are paying their fair share. I made mention in the materials here about the P's limitation. Again, something to keep an eye on. It was removed. It might be restored, and it's really just an additional excise tax on those having taxable income, again, most likely above 400 grand. So bottom line with respect to where we may end up on tax legislation, expect to see something this fall, expect to see a change in tax rates, expect to see a concentration on higher income taxpayers. There will be some opportunities we expect with respect concerning our ability to ease some of that blow, especially as Congress looks at changing the capital gains rates, perhaps less so in estate tax planning, but there's going to be a lot of action going on, and so keep an eye to it. Bottom line here, in the time we've got left, steps to consider. Be sure to read up. I'm not so sure as it will be helpful to you in the next 3 months to be reading all the tax literature, because things are so new and will doubtless change. But by the time we get to late summer and fall, there will be tax legislation. Segment your giving spheres and your approaches to them. Every organization has different levels of givers, and the tax law, perhaps now more than ever, segments them and treats them differently. You should understand where your dollars are coming from, or where your hoped for dollars are coming from even, and be able to understand the tax benefits within that segment. I do think it's important for us to work through our associations and organizations that do advocacy, do lobbying, because it's important that our story get told. The disinformation on DAFs is a great example, or perhaps a horrible example, of how things get mischaracterized. And again, as I put here, watch for new developments. I think that's going to increase as we get closer to the fall, but you're going to need both through this organization and others that you participate in to try to keep yourself up to date. So with that, thank you for your time. I hope it was helpful, and I'd be happy, Emily, to answer any questions in the time left.
Thank you so much, Mike. I am just going to take a look at our chat and our questions. Okay, so one of our questions from earlier on in the presentation was a question about, Joel, I hate to put you on the spot, but it was a question about whether, your question was, is it 600 per person or 600 per household? Let's see if I can get to see.
Yeah, I think on 600, that has to be from the non-itemizers, which was $300 in the CARES Act earlier in the year, $300 for an individual over and above whatever your non-itemized, your non-itemizer, so you don't need to itemize. You could give $300 away and still have that count. In the law was changed so that it's 300 individually, 600 married filed jointly. So you and your spouse can both eat up $300.
Thank you, Mike. One of the other questions that we received from Rebecca was, just to clarify, is there currently no minimum distributions on DAFs?
Legally, that's correct.
Okay.
Many DAF providers, however, organizations that sponsor DAFs, will have a suggested or in a couple cases required minimums. They're trying to avoid the imposition of that hard and fast rule on 5%. So,
Thank you. If anyone else has questions, feel free to put them in the Q&A or in the chat. I guess, Michael, we know that you're involved with many different councils, organizations, nonprofits, both professionally and personally. So I guess I have two questions. The first one, when we talk about being able to own the narrative and feel comfortable talking about tax laws and knowledgeable donors, like what do you see from nonprofits that are like really killing the game, really owning it, really incorporating this into their work and their approach to fundraising for the year and the years ahead? What type of tactics do you see?
yeah, I'm seeing a strong shift to higher end giving. Now, that may be a product, and undoubtedly is a product of the sort of clients that I deal with. But just as there's this wealth disparity that has been growing and has only gotten bigger in the pandemic, right? You're either overjoyed that the stock market is doing so well, or you're looking for a job. It's incredible. That same dichotomy seems to be playing out, no surprise, in charitable giving. But no matter what, it's still incumbent upon us to be able to own the narrative, to be able to sell the narrative, to understand those particular tax rules that apply to the level of giving that we expect from the person sitting in front of us, right, our prospect, and be able to play that out. I wouldn't want to suggest in the least that you should, look for multimillionaires subject to this billionaire tax, although that would be a great lunch.
Sure.
Yeah, I don't know if, right, Mackenzie, Jeff Bezos's wife, Mackenzie, just got remarried, so I think maybe she's done with her giving for a while, right? Or maybe not. But in terms of looking at those folks, you still have a community of strong givers, people who believe in you, and you've got a responsibility to speak to them as well.
Thank you. Looks like we have one other question in the chat. Says, I've heard that April is the new December. Can donors contribute to their DAFs until they file their taxes, or is December 31st still the cutoff date for any given year?
That's interesting. Yeah, December 31st is the date for any contributions. I don't know why there would be something particular about DAFs extending that out. Corporations, being on accrual method or whatnot, have an ability to make gifts into the next year. It's somewhat limited, but I'm not aware with something that applies specifically to DAFs.
Okay. Any other questions? I see one more comment. Hang on one second, Mike. All right, this question is, are there process measures or business criteria that major donors seek out to judge the effectiveness and quality of a nonprofit in fulfilling its mission?
Yeah, well, I would say, again, there are a number of, they don't like the term, but charitable rating agencies. I mean, as I said, I'm involved with Charity Navigator, and the entire concept there is to try to provide some basis of comparison about whether or not organizations are doing what they should with their money or not. 3 stars or 4 stars. So that certainly is out there. If someone has a family office, right, they can spend a lot of money going out and doing that same sort of research. But there are a lot of more off-the-shelf, easily available, no cost options that are available to donors. And Emily, important on that, you should always know where your charity is ranked by those organizations, because your donors will know.
So, a little off topic question, but for being on the board of Charity Navigator and knowing that so many of us are trying to become more inclusive fundraisers, more equitable fundraisers, and raise money to create a more just community, are there any measurements on Charity Navigator that speaks to, especially because we as a community are having more and more conversations and as the nation about social justice and equity?
Yeah, so it's a great question. And the fact of the matter is that Charity Navigator now has a focus in light of diversity and inclusion. We were hearing that money didn't always make its way to the places of the greatest need, and that those needs were not getting amplified sufficiently to be able to attract charitable contributions. What as they say, you know, it's hard to remember when you're up to your neck in alligators that your job is to drain the swamp, sort of thing, right? It's easy to get distracted with so much going on. And so Charity Navigator specifically, I can speak to that, now has a portion of what it has available for free to focus people in those areas where the grant making is the most needed.
That's awesome.
Yeah.
Mike, I think we have just our final question, and that is, can you elaborate a bit about the 4 measurements being used by Charitable Navigator?
Yeah, I could go through, but it would take a lot longer than the time that we have. What I would suggest to you is the website is incredibly transparent and everything is set forth there. And even if you're an organization that's not of a size or not of a type that's rated by Charity Navigator, I would suggest to you that you might want to look closely at those items because they're the same sorts of things that donors might be interested in.
That's awesome. Mike, thank you so much. We so appreciate having you as a resource to our community and our organization. We are very grateful for your hours spent with us.
It's always a pleasure, and I wish you all the very best of good luck. You're doing great work.
We're all going to have our lunches with our multi-millionaire donors now and talk about some tax laws.
Yeah, exciting stuff.
Sounds great.
Thank you.
Thank you so much, Mike. Have a great day.
Bye-bye.